Good afternoon, everyone. We will be presenting marginal analysis. Marginal analysis is a decision-making tool to help maximize profits based on marginal incremental changes to resources instead of one based on totals or averages. The benefits and costs of different alternatives are examined to determine the effect on total revenue and total costs caused by a slight unit change in output or input of each alternative. Marginal refers to additional. All economic decisions involve marginal benefits and costs. Marginal analysis allows business owners to measure the additional benefits of one production activity versus its cost. It helps to understand whether an activity is profitable and make a decision based on that information. Cost of an activity is measured against changes in volume to determine how the overall change in cost will affect the business. Individuals use marginal analysis to make everyday decisions by looking at the worth and opportunity cost of the decision.
Okay, so there are three types of marginal analysis, and they are as followed. Marginal benefit or marginal utility. This can be defined as the additional satisfaction or utility that a person receives from consuming an additional unit of a good or service. A buyer derives the most satisfaction from consuming a product where marginal utility equals price. Next, we have the marginal revenue. This is defined as the additional revenue from an additional unit of sale and marginal cost. And marginal cost is the additional cost of producing each additional unit of a product. At this point, a seller earns the most benefit from selling a product where marginal revenue equals marginal cost. Finally, we have the marginal product, which is the additional output from additional units of input, and this applies to production and recruitment decisions. For the sake of this presentation, we will be focusing on marginal benefit, and we'll provide an example to further explain the concept.
This is Paul. Paul has a tough decision. He is in need of a textbook for a class. He went to the bookstore to find the book available for rent. The rental agreement is for January through April at a cost of $20 a month. A $20 processing fee as well as $20 is needed for the first month's rent. Every subsequent month is $20. Any additional month not included in the original agreement is $25.
Now, Paul must conduct marginal benefit analysis. 1, he can retain the book, pay an additional $25 and improve his chances of doing well on the final exam. Or 2, he can pocket the $25, reject that said benefit of additional days, and send the textbook back in its due time. Keep in mind, marginal benefit is about additional satisfaction that a person receives from consuming an additional unit of goods or service.
Here, under the current agreement, it will cost Paul $100 to rent this book. However, if Paul decided to keep the book to ensure a favorable grade, he would then have to pay $125. Confronting with paying an additional $25 or risk not doing as well in his class, Paul has decided that he would be willing to pay the additional $25. And therefore, the marginal benefit of keeping the book until the exam is $25. And this today concludes our presentation.